Hi, everyone, and good afternoon. Thank you for tuning in to today's Market Color call. Before Jordi shares his thoughts, we would like to share our compliance department's thoughts, which are as follows. Weiss does not recommend particular stocks, bonds, options, derivatives, or securities of any kind. We do not guarantee any results or investment returns based on the information you receive. Although we have used our best efforts to provide the most innovative trading and investment strategies, the views presented today are forward-looking statements, which are subject to change as circumstances change, and we cannot promise future profitability. If you have any follow-up questions after listening to the webinar, please reach out to Jordi or the marketing team. We would love to hear from you. A replay will also be available on our website. Jordi, the floor is yours.
Thanks, Amanda. Hi, everyone. Lots happened since I last did one of these in May. We're continuing the pace of change that we've seen really since February in the markets. And I just wanted to take you through some things because some things are becoming, I think, more important. We talked about a lot of these in the last one about looking for reflation and expecting a bounce in economic data that was significant. This is really going to take you through kind of four parts. One is just make sure you're aware of the extreme nature of the economic data turnaround. Look at it from an MMT perspective. So modern monetary theory is a secular change. And I do not think enough people fully grasp what has gone on in the last 2 months. I'll talk about the implications in it from reflation to inflation, which I believe we will see much faster than what you would normally see coming out of something like this. And there's a bunch of reasons for it that just has to do with cash. Then I'm going to talk about value versus growth and all factors. We've seen a lot of shifts in factors so far, really in the last 6 days, beginning this month, some of them historic. I'll take you through that. And then I'm just going to finish up with emerging markets, which I think are presenting a laggard opportunity here for people, which will accelerate from now into the end of the year. And I believe this to be a secular change also in emerging markets. So to start out with, just plain and simple, this is the City Surprise Index for the globe, overlaid with the PMI. And that was through the last time that I did one of these in May. So I'm just gonna, if you watch the white line here, what you're gonna see is the massive spike that we've seen in economic data across the globe relative to expectations. And that's the key thing, is we've seen this not only in the globe, this is the US alone, and you can see how the white line jumps up here. This is all based on surprises. So the data that's been coming out has been surprising on the upside across the board. This is the payroll numbers that came out relative to expectations. Obviously, we beat the numbers on all levels, and people were confused as to how there could be that much job creation. This is the Canadian jobs, which on the same day came out. The white line again is the actual number. The orange line is where the forecasts were. It beat by 700,000. In the case of the US, it beat by multiple millions. This is the auto sales, which came out at 12 million versus 11 million. I've shown this in prior webinars that auto sales are driven historically by the S&P movement. The S&P is near all-time highs, so we should expect to see auto sales continue. It's not just in the US where we've seen the bounce in auto sales. Year-over-year auto sales in China through April went to the highest level since 2018. This is China auto sales versus the US auto sales. The white line is China. China's numbers came in up here on the most recent one. So you can see the US is just behind it by 2 months, but we should expect to see that moving forward on the auto sales as we go through, both for the S&P, but some of the other things that I'll show. This is the PMI less new orders. So we are currently at 11, which means the headline number in the PMI is up in the 40s, while the new order category only jumped to the low 30s in May. Remember, we saw some reopenings in May. You saw a lot of them continue as the month went on. You're going to see a big jump in new orders. The reason I put this up there is you already have the headline PMI up in the 40s with the new orders down there. That's a big move, and that just means that we're very likely to see a PMI above 50 before we get into August. I mentioned that this is really important as an indicator relative to sentiment, because almost all sentiment numbers have people expecting the PMIs to reach 50 past the third quarter of this year, with the bulk of them into next year. So we're just moving faster on the economic than what economists thought, and with market participants. That becomes very important for the MMT portion. This is one of the major reasons, and again, not enough people seem to be focused on this. This is the supply delivery time. So what you'll see is we are still at the highest level, even with the move down. We are still having issues with the supply chain and getting stuff out in a timely fashion. This is elevated. That helps to keep the PMI, the headline PMI there. There's an inflation component or an input component, which will add to getting the PMI above 50. So orders are going to come, but if you also have supply disruptions and prices going higher, you're going to have faster and higher PMI than what people think, and that will have implications for the market. This is just overlaying that PMI, which again is at 43.1, the headline number. You have supply deliveries still way above where they were, showing the impact of the supply chain disruption, which I think is going to last much further than most people seem to believe. This is it on the non-manufacturing side. Again, the supplier delivery time. Now, this is the thing that to me is the most important. This is a surprise. So this was a release for personal income month over month in the US. The orange lines were the expectations. So the expectations were for minus 5.9% in income. It came with a growth of 10.5%. Very few people write about this or talk about the implications. This is the beginning of the MMT conversation, which to me should be getting much more attention, because it is the part that will speed up the growth side or the new order side. So the surprise was there. When you go through the details, wages dropped about $1 trillion from 9.5 to 8.5. And that's part of income. Where we made up the difference with a $3 trillion jump is in transfer payments. So transfer payments increased by $3 trillion to offset the $1 trillion loss that occurred in wages. This is where the whole thing gets important. People lost their jobs. The government is bringing more money to the table. Here's the savings rate going back to 1959. The savings rate, because of the increase, jumped from before. At the beginning of the year, we were at 8% savings rate, which was kind of the midpoint of the range over the last 40 years. We jumped up to 33% as of the last reading because of this massive transfer of cash of disposable that now sits in disposable income. How do we have that big of a jump? Well, you saw the increase in income. At the same time, you saw expenditures drop by 3 trillion from 15 trillion down to 12 trillion. This is personal income versus the expenditures. So this is to put it in one chart. So you can see the drop off in spending. You can see the massive increase in income. So what we've got is a savings rate, which is there now. And you should expect, with the savings rate at that level and personal disposable income growing that fast, that would already be enough to get spending going. But you also had a surprising increase in jobs. Now, this is total aggregate weekly payrolls, which also takes into account hourly earnings and hours worked. So between the jobs that were created, a big jump in weekly hours and a big jump in a continued high level of earnings, as we're creating more jobs, this was not expected to happen this soon. And so you've already given the money out to people, and now you're getting the job creation. So you're going to have a double impact to the demand side that's going to come through. Remember, the government was estimating, so all of these programs that were put in place were meant to offset. There was an estimate as to how bad the virus would be, how long it would have an impact on consumer spending. We're already seeing that enough money went into the system, and as we're reopening, we're getting faster and faster spending levels. Now, the reason this is important, this orange line here is where retail inventories are. Retail inventories were already low. It's overlaid with personal income year over year. So what you had is we already had retails at low levels, mainly because of what had happened with China and the tariffs, mainly because of the slowdown we had before. So with this massive jump in income and low inventories and the supply delivery disruptions that I mentioned in the earlier ones, I expect there to be more shortages. You've probably read already about bike shortages, pool shortages. There should be auto shortages based on the fact that we're having trouble on parts, but also because the demand is coming back too quickly. If you believe in the theory of urban flight, which I'm seeing in Manhattan every day, as people move back out into homes, you're going to have shortages of cars and of things that they need to purchase. I believe there's an investment theme there that has not been noticed by people yet. This is showing how long it takes before inventories start to be able to be built relative to demand. So if you look at Lehman Brothers right here, going into this, you had wholesale inventories coming down from these levels. Wholesale inventories are already down here before we even get a bounce back in new orders. As new orders go higher, you will draw down inventories, which are already at very low levels, much lower than they were going into Lehman when it was already down here. You can see that back then we had inventories up here. We're at lower levels. So the relationship between how much money we're giving normally to come out of a recession versus the inventories is a problem. And just to show you the impact we had on what went on during April or March, this is what happened to food retail inventory. So you had a massive drop off, historic drop off in inventories. We saw the hoarding going on. You're going to see similar implications happen in other parts of the marketplace, in my opinion. And the inflation expectations continue to go higher. I showed you this chart in the last webinar. Michigan 1-year inflation expectations have jumped to the highest level now in 5 years, and it's gone up during the pandemic. So I would expect to see, as inflation expectations are going higher, and as we're actually seeing this go through, you'll get to see more people, and I think you're going to start to see prices going higher much faster than people realize. Here's the money supply. Again, this is over the last 15 weeks, going back to 1980. Very surprised this is not getting more focus. When you look at the income and then you add the M2, and then you also look at where the budget deficit came in the last month. We're going to get another release this week. I highly recommend paying attention to it. It does not get a lot of press. I believe it's out on Wednesday. But the budget deficit, to me, is a part of MMT, which is going to be a bigger story going forward. We've done much more than the rest of the world. The dollar has been stronger going into this. I believe that the deficit will become a focus as we get into the election, but as we start to realize how big the numbers are. Here's the current level of the budget deficit off the last release. This is through April, which was at -9%. A lot of the outlays have not shown up in this yet. The expectation is this for it to drop by another 4% to bring us to new levels, but by the end of the year, based on the estimates that I've seen, which would be $4 trillion, this is expected to get all the way down to 20% of GDP, which would be historic, obviously, since 10 there is the worst that we've seen. To show you the relationship over the last 30 years to the dollar, the orange line is the deficit. Again, we were down here. We're expected to take this way through the lows. This has been the dollar. We ignored it from here on. To me, that was related to the tariffs. So we had a dollar premium in there during the tariffs with China. There was also other reasons as to why it should break, but with the deficit and the amount of spending we're doing here, I fully believe that the dollar will start to weaken. There's another change that's happened, which is structural during this time period, which is we've seen the interest rate differential. This is between 2-year rates in Germany and 2-year rates in the US. The white line is showing the interest rate differential. So we've gone all the way back now to the 2015 levels. You can see the orange line, the dollar is weakening. I expect it to continue to weaken as we go forward. This is the money market assets. This is over the last 15 weeks. So again, you can see massive amounts of cash that's being built up. It's not just the savings rate. It is also showing up in money market funds. That is a lot of cash that's available, again, for the stock market. In terms of the stock market, I've continued to emphasize all of these weeks that we have sentiment at extremely low levels. The AAII release, which comes out every Thursday, has now been negative, meaning more bears than bulls 15 weeks in a row, all during the fact that the market has rallied. We still are at -4 as of the last print. This is the average over the last 10 weeks. The only time we've been lower was during Lehman Brothers in here and back during the last recession, or the recession before that in 90, and then a brief period in here. So sentiment, shockingly, is still low with this massive rally that has come up, leading to, I think, having more upside from here. Now, so far this month, it has been a massive unwind in factors. You've probably, for those of you that have investments with hedge funds, I'm sure there's been a lot of dispersion of returns. This is going to be the reason why. over the last 5 days momentum, we've seen a 27% drop. The largest drop since the internet bubble unwind peak in April of 2000. At the same time that market neutral momentum has gone down, that has some industry and sector exposure to it. This one is pure momentum. This is the largest 1 week unwind in pure momentum going back, even worse than the internet bubble. This is the growth factor, down 13% for the week, also a record. This is what's driving most so far as of now. This has really been the short side. So this is the short side of growth. So this would be the low growers. Think of them as the names that have the lowest multiple, but they probably have the lowest earnings growth. They outperformed the S&P in the last 6 days by 15%. Before that, the largest we saw was about 7. So this is double the biggest move we've seen, and that was during Lehman Brothers. Here we have the long side of growth relative to the long side of value. So now this is bringing the long growers in versus value. I mentioned that I think we're at a secular shift of value. So in this case, the long side of value is outperforming growth, and it did last week by 12%. That is the biggest move we have going back 20 years. This is showing quality versus beta. So the white line, which I've shown you in prior webinars, suggesting, in fact, the last one that I did, the last webinar, we were right here on growth versus value, and I made the argument that this was a leading indicator that had worked back in 08. It continues to move, meaning beta is outperforming quality, or junk is outperforming quality, and that is pulling down again in the same way. There is a relationship there. It continues. Just to highlight again, this is what it was in 08, and the same thing happened. The quality versus beta trade was leading the growth versus value trade. We're seeing the same thing here. This thing lasted for a long time, and it continued all the way in until, for about 6 months. I expect this to continue to go as long as the economic data continues to surprise on the upside. This is the impact that it's having on hedge fund positions. This is the Goldman Sachs crowded long position relative to the crowded short position. That would be the white line, which has been breaking down along with the growth versus value. So it just says that a lot of funds have been parked in growth over value. The unwind is in the very early stages to me. There'll be pauses and bounces along the way, but I think this will continue. Here is the opportunity for it. Going back to 2001, this is showing you the differential between value. So this is the expensive names relative to the S&P. That's the white line here. This is the cheap names relative to the S&P down here. You can see this dispersion of these two groups, which has led to this differential between them. The only time we've seen anything like this is coming out of the internet. I've seen people talk to me about why we didn't see a big value over growth shift coming out of the last out of the last recession during the great financial crisis. That's because the differential between them had not built up. We've seen a huge movement in this over the course of the last 2 years on the back of the tariffs, and then with what we've seen, which has led to this PMI unwind. When PMIs start to bounce, you start to see the reflation type names or the cheaper names move higher. I think that will continue again going forward, but this is just showing the opportunity. This is value versus growth. So this is the Russell value versus Russell growth. This had the largest weekly move since April of 09, which was right near the lows in 09 or May of 09. Also when the PMIs went up, and then you saw the same thing happen in 2000 and 2001 during the last beginning of value over growth. Here's something that's important just to keep in mind. This is the energy sector relative to the information technology sector inside the S&P 1500. That is the orange line. The white line is value versus growth. So at the end of the day, value versus growth has been the transition away from the commodity or industrial side and into the technology side. With the interest rate differentials, and I've shown you in prior webinars that MAGA, Microsoft, Apple, Google, Amazon, total market cap is bigger than every other sector in the S&P. That has all occurred during this period, which is right about when the iPhone started in 07. I believe we're now going to see a change where you're going to see a move to value based on MMT. The whole concept behind MMT is the distribution of wealth problem, or the have and have not debate. A lot of what we've seen with populism and everything has been based around that. All the elections coming up and everything is going to have to focus on what we've done with MMT and the amount of printing we've done, and make sure that certain things happen. There will be more regulations. I'm sure there'll be breaking up of big companies. I would continue to focus on value versus growth as a secular change, having a lot of implications for the marketplace as it has in the past. The other thing outside of commodities relative to tech is emerging markets relative to the S&P. So again, this is value versus growth overlaid with the EEM versus the S&P. Obviously, there's a currency component in this as well. The main point is that as you've had this trend go on, you've also seen the US market outperform the rest of the world. So I like the rest of the world over the S&P going forward as part of this. This is just another part of why EEM should be looked at right now. This is the last 16 days of 16 days of emerging markets. The currencies have strengthened by 6.9%. It's the biggest move we've seen in the last 10 years, suggesting that the currencies are getting a bid from a very oversold position as the dollar is beginning to weaken. This is just showing the relationship between sovereign spreads and the currency. So the white line, which has been leading down here, has been sovereign spreads. The way emerging markets usually move is you get the move in the US in terms of credit, then you get it spread into sovereigns, and eventually the currency moves, and then the equity moves. We're in that stage right now, so that's why I said this is a laggard opportunity to be able to jump into. Going forward, I think everyone should pay attention to this, because I think this is going to be a trade that people should be thinking about. This is the risk premium right now that is in sovereign spreads. So this is the emerging market sovereign spreads, or I'm sorry, sovereign yields at 5.7%. And this is the BBB investment grade part of the US, which is currently offering 3.3%. I think the investment grade market will continue to have a lot of trouble coming out of this with some of these bigger companies. I don't know how they're going to be able to deal with the debt they have outstanding. And I think emerging market debt is a far better opportunity with 200 basis points of risk premium built in. So I'd be looking for emerging market debt as well. And then finally on this front, emerging markets have been rallying. This is the technology side. This is EMQQ. It is led. Now we're starting to see the catch up from what I consider to be more the industrial part of EM, which is EEM. So you're already seeing a leading indicator drag saying it's going higher. So overall, I wanted to make sure I gave you an update on this. As it's always the case, I'm happy to go through any of the details on this, but I do think we're seeing an important time. Watch Wednesday for the budget number, and pay attention as the dollar continues to weaken here and the unwinds in momentum continue. That's it for this webinar.
Thanks, everyone. Have a great afternoon.